Learning outcomes. After studying this module, you shall be able to understand the meaning of securitization and its process, describe various types of securitized debt instruments like mortgage-backed securities and collateralized mortgage obligations. Understand the structure of several types of collateralized mortgage obligations, differentiate between traditional fixed coupon bonds and mortgage bonds. Introduction to securitized debt instruments. Banks and financial institutions grant various types of loans which appear on the asset side of their balance sheet. Securitization is a process in which loans of similar nature are bundled together and sold to an entity known as a special purpose vehicle. This process removes such loans from the balance sheet of bank or financial institution and enhances their liquidity. Thus, they can disperse further loans with the help of funds generated from sales proceeds received from the sale of bundle of loans. Thus, it leads to availability of more funds with banks, which can be further used to disperse fresh loans to new borrowers. A specific entity special purpose vehicle SPV bundles the new base loans with similar characteristics and debt securities are issued to investors against the bundle of assets. Because the bundle of loan is securitized and those debt securities are issued to investors, therefore, these debt instruments are popularly known as securitized debt instruments. The bundle of loans may be mortgaged loans, auto loans, credit card, etc. When the debt securities are issued against mortgage loans, then these debt securities are called mortgage-backed securities. When the securities are issued against other bundle of loans like car loans, credit cards and other types of loans, they are called asset-backed securities. Benefits of securitization. Securitization process results into several benefits which can be described as follows. First, when the banks or financial company sells the bundled loans to a special purpose entity, then the balance sheet of bank frees from these assets and this allows them to disperse more loans while meeting their asset liability matching criterion. B. Fresh funding is received by the banks, generated from the sale of bundled loans. This infuses more liquidity in banking system, which can be used to disperse more loans to fresh borrowers. C. Because sufficient liquidity is infused in the system, therefore, fresh loans may be issued at lower rate, which benefits the borrowers. D. The loans or assets which are lying idle on the balance sheet of banks gets converted into tradable debt securities and thus enhances liquidity in the system. E. Pooling the assets and distributing the securities among investors lead to diversification of risk because all the assets in the pool will have varying degree of risk and return. F. The investors get a new class of debt securities which are more rewarding in comparison to traditional debt securities, albeit with a higher risk. G. Intermediaries benefits from the fee-based income and income in the form of spread income earned by them in this process. Yield on securitized bonds. Generally, the yield on securitized bonds will be higher than the traditional fixed coupon bonds. In order to attract the investors to invest in these more complicated and risky debt instruments. However, the yield will be lower than the coupon of the bundled mortgages or pool of assets. The yield spread may be in the form of Z spread, in which a constant spread is added to spot rate. The yield spread also depends upon the embedded options in these bonds. If there is a callable or putable option, then in that case coupon does not depend upon the path of market interest rate movement. Yield spread or bond price can be calculated by using binomial tree method. When the bond coupons are influenced by the path of market interest rate movement, then Monte Carlo simulation has to be used for bond pricing. Process of securitization. Banks have several mortgage loans in their loan portfolio. These loans are backed by the property, residential or commercial, for which these loans are dispersed to borrowers. The bank or finance company sells these loans to another entity known as special purpose vehicle, securitization company, which will bundle the loans with similar characteristics. This entity will issue the bonds or debt securities to investors, which will be backed by this bundle of mortgage loans. Such debt securities are known as mortgage-backed securities. The coupon on these bonds will be similar but less than the coupon charged by the bank or mortgage loans. The interest and principal repayment received from borrowers of these original loans will be used to service these debt securities issued to investors and to pay the service fee to various intermediaries involved, their credit rating agency, investor banker, trustee, guarantor, etc. This can be depicted by the following diagram. These securities are rated by authorized credit rating agencies. These are structured by a structure, usually an investment banker, into various classes. He decides the timing and pricing of the issue based on their rating and capital market conditions. The price of the mortgage-backed securities also get influenced by market interest rate movement and follow an inverse relationship with the interest rates. These bundled loans also have the risk of prepayments by the original borrowers whenever market interest rate falls by a larger extent, because these borrowers may prepay their costly loans and refinance it with the prevailing lower rates in the market. Thus, these debt securities are affected by the prepayment risk by the original home buyer in addition to default risk by them and interest rate risk caused by market interest rate movements. Because of these inherent risks involved, many investors may not have the appetite to invest in these risky securities. Therefore, in order to attract the different categories of investors, these securities are structured into different types or tranches where each tranche has unique risk-return characteristics based on its credit rating and the quality of bundled mortgages. These are also known as collateralized mortgage obligations. Structure of securitized debt. First, mortgage-backed securities. The structure of securitized debt may be in the form of pass-through or pay-through. Mortgage-backed securities are backed by bundles of several mortgages of similar characteristics. In US, these mortgages are sold to either government-backed agencies like Fannie Mae or Freddie Mac, Ginnie Mae sponsored by US government, or to some private investment bank. The majority of MBS are issued or guaranteed by an agency of the US government such as Ginnie Mae or by GSEs including Fannie Mae or Freddie Mac. MBS carry the guarantee of the issuing organization to pay interest and principal payments on their mortgage-backed securities. While Ginnie guarantee is backed by the full faith and credit of the US government, those issued by GSEs are not. A third group of MBS is issued by private firms. These private level MBS are issued by subsidiaries of investment banks, financial institutions and home builders whose creditworthiness and rating may be much lower than that of government agencies and GSEs. These entities securitize the packaged mortgages and sell to investors. In the pass-through structure, the interest and principal repayment are periodically received from the home buyers whose mortgages are pooled and debt securities are issued against them. The investors of mortgage-backed securities have invested in them and the funds received from them are passed to bank, and in turn liquidity is created in the system. However, these MBS have to be paid periodic interest and principal repayment. The cash flow received from original home buyers are passed to investors of mortgage-backed securities in order to service their periodic interest and principal repayments. The MBS may be backed by residential mortgages known as residential mortgage-backed securities, and the type of real estate will be individual family real estates. In case of another MBS, the pool of mortgages may contain commercial real estate like offices, business parks, retail commercial buildings or multi-family apartments. Such MBS is known as commercial mortgage-backed securities. In case of traditional fixed coupon bonds, investors receive periodic interest and principal is repaid at maturity in one single installment. In case of MBS, principal repayment takes place periodically with each interest payment, which may be monthly or quarterly payments, the way amortization of home loans takes place. Therefore, the face value of these MBS will also continue to decline with each periodic payment which has interest and principal component. Initially, interest component will be higher, while in later installments, principal component will increase. There is always a difference in the timing and amount of cash flows received from home buyers and interest and principal repayments made to MBS investors. In addition to the debt service of MBS, monthly cash flow received from original buyers have to be used for paying servicing fee to guarantor, underwriters, structurer, credit enhancers, etc. Thus, pass-through rate offered to MBS investors is less than the coupon rate of packed mortgages. Similarly, home buyers make their periodic payments at the beginning of each month, while the cash flows are passed on to MBS investors later. The pool of mortgages against which MBS has been issued contains the mortgages with different coupons and different maturities. Therefore, the coupon rate offered on MBS is calculated by taking the weighted average coupon of all the mortgages. To calculate the weighted average coupon, following method is used. Weighted average coupon is equal to sigma weight of each mortgage in the pool multiplied by coupon rate of that mortgage. Similarly, the maturity period of MBS is the weighted average maturity of pool of mortgage. It is calculated in the following manner. Weighted average maturity is equal to sigma weight of each mortgage of outstanding balance in the pool multiplied by remaining term to maturity of that mortgage. Example: if a pool of mortgage contains 3 mortgages with the following characteristics. Let's see a table. Mortgage 1, weighted mortgages 0.40 of coupon rate 8%. Second mortgage with a weighted mortgage 0.25 with a coupon rate 7.50%. The third 0.35 and the coupon rate is 7%. Now let's calculate weighted average coupon. When we applied the formula, 0.40 multiplied by 0.08 bracket close plus bracket 0.25 multiplied by 0.075 bracket close plus bracket 0.35 multiplied by 0.07 bracket close. We get 0.032 plus 0.01875 plus 0.0245, which equals to 0.07525, which is equal to 7.525%. Weighted average maturity in months is equal to 0.40 into 200 plus 0.25 into 150 plus 0.35 into 200 equal to 80 plus 37.5 plus 70. So, we get a total of 187.5 months. Collateralized mortgage obligations. Another structure is known as collateralized mortgage obligations. In this structure, securities are based as tranches against a pool of mortgages. It means that entire lot of securitized debt is broken into tranches or slices where each tranche carries unique risk return combination. This is done because in the market there are different type of investors with different investment needs in term of risk return requirements and investment horizon. Some are concerned that cash flow payments may be delayed or non-payment may take place because of default risk, while some other investors are more concerned toward the prepayment risk by original home buyers. To meet the needs of different categories of investors, the cash flows, payment priorities and risk return characteristics of debt securities are delinked from the cash flow and risk return characteristics of pool of mortgages from which these debt securities are created. Out of entire pool of mortgages, some tranches are issued with high risk, high return characteristics, for which low priority is given for cash flow payments, while some other offers highest safety reflected by high credit rating and commensurate return with high priority for the payment of periodic interest and principal, and therefore low prepayment or default risk. This structure doesn't eliminate the risk, rather it redistributes the risk among different tranches, and investors can invest in a tranche selected as per their preferences. This is a senior subordinate structure to deal with credit risk called credit tranching. The subordinate or junior tranches will absorb all the losses up to their value before senior tranches begin to experience losses. Subordinate tranches typically have higher yields than senior tranches. Due to the higher risk incurred, investors can choose which one they want to invest in according to their risk tolerance and their outlook on the market. Therefore, these tranches attract broader classes of investors in comparison to MBS or pass-through certificates, where entire lot offers single risk return combination. These securities are also known as collateralized debt obligations. Structure of collateralized mortgage obligations. There are various types of structures of collateralized mortgage obligations. These structures differ in terms of distribution of interest, principal and repayment received on mortgages among the various bonds or tranches. These structures are described as follows. First, sequential pay tranches. In case of sequential pay tranches, CMO is structured in a manner so that each class of bonds can be repaid sequentially. Monthly coupon, principal and prepayments received on mortgages are distributed among different tranches in the following manner. First, all the principal payments and prepayments are first distributed among tranches first. After tranche first is completely paid off, then payment is directed to tranche second, and so on. Second point, monthly coupon received at the beginning of month on mortgages is distributed among all the tranche based on the amount of principal outstanding on them at the beginning of month. Second point, accrual tranches. In case of accrual tranches, monthly coupon, principal and prepayments received on mortgages are distributed among different tranches in the following manner. A. A coupon received at the beginning of month is distributed on all the tranches based on their outstanding balance except on one tranche known as Z bonds. The coupon payment which would have been paid on these Z bonds is used to pay off the principal of other tranche. The coupon payment on these Z bonds continue to accrue based on their principal outstanding and previous month's accrued coupon which is added to principal outstanding each month. B. All the principal payments and prepayments are first distributed among tranche first. After tranche first is completely paid off, then payment is directed to tranche 2, and so on. Once all the tranches are completely paid off, then principal and all the accrued interest on Z bond is paid off. Third point, floating rate tranches. Floating rate tranches carry a floating rate coupon. Their coupon moves along with the market interest rates. As their coupon rate movement is aligned with market interest rate movement, their interest rate risk is quite low. The mortgages from which tranche are created have fixed coupon rate. Therefore, it is difficult to create floating rate tranche. In order to create floating rate tranche, a fixed rate tranche is used, and from that a floater and an inverse floater combination is created. Fixed coupon on fixed rate mortgage is split into floater coupon and inverse floater coupon. The rate is normally linked to a preference rate. For example, rate may be LIBOR plus 50 basis point. For floater rate will move along with the reference rate, while the inverse floater rate will move in opposite direction of reference rate movement. Structured interest only tranches. In this type of CMO structure, a specific tranche is created on which only interest is paid. They are known as structured IOs. In order to create structured IOs, coupon rate of all the tranches is set below the mortgage coupon rate. The excess interest received on mortgages after meeting coupons on all the other tranches is used to pay the interest on structured IOs. In case of structured IOs, only CMOS, monthly coupon, principal and prepayments received on mortgages are distributed among different tranches in the following manner. A. The coupon received at the beginning of month is distributed on all the tranches based on their outstanding balance except on one tranche known as Z bond. The coupon payment which would have been paid on these Z bond is used to pay off the principal of other tranches. The coupon payment on these Z bonds continue to accrue based on their principal outstanding and previous month's accrued coupon, which is added to principal outstanding each month. The interest on the structured IO tranche is paid at the beginning of each month on the basis of notional amount of outstanding principal on the other tranches. B. All the principal payment and prepayments are first distributed among tranche 1. After tranche 1 is completely paid off, then payment is directed to tranche 2 and so on. Once all the tranches are completely paid off, then principal and all the accrued interest on Z bond is paid off. On structured IOs on principal payment takes place as they are interest only tranches. Their notional principal outstanding continues to decline based on the principal payment to all other tranches. Fifth, principal only tranches. Some mortgage securities are created so that investors receive only principal payments generated by the underlying collateral. The process of separating the interest payment from the principal payment is called stripping. These principal only securities may be created directly from mortgage pass-through securities, or they may be tranches in a CMO. In purchasing a PO, investors pay a price deeply discounted from the face value and ultimately receive the entire face value through scheduled payments and prepayments. The market value of POs are extremely sensitive to prepayment rates. If prepayments accelerate, the value of the PO will increase. On the other hand, if prepayment decelerate, the value of the PO will drop. A companion tranche structured as a PO is called a super PO. Sixth, planned amortization class tranches. Planned amortization tranches are given highest priorities in terms of payment of periodic principal and interest. Their cash flows follow a planned pattern and are quite predictable. They have least exposure to prepayment or delayed payment risk. This is so because their risk is absorbed by support tranches. The cash flow payment to PAC tranches are as follows. A. The periodic monthly coupon payments received from the mortgage pool are dispersed to each tranche based on the principal outstanding and that tranche at the beginning of each month. B. When the prepayments of mortgages are very low, then the principal repayment received from the pool is first used to repay the planned principal, repayment of PAC tranche and any balances paid to support tranches. When there are lot of prepayments on the bundled mortgages, then to PAC tranche are paid only the planned principal repayments on them, and any excess cash flow has to be transferred to support tranche. Thus, PAC tranche have minimum prepayment or extension risk, as their risk is absorbed by support tranches, also sometimes known as companion tranche. Next, support tranches. The support tranche, as the name implies, provides support to PAC tranche and absorb their prepayment and extension risk. Thus, they bear maximum extension or contraction risk. In case of delayed payments from original home buyers, they sacrifice their principal repayments so the PAC tranche planned cash flow payments can be made. In case of heavy prepayments received, they absorb all the excess cash flow payment received so that the PAC tranche planned cash flow payment is made. Thus, they absorb the highest risk in order to support the PAC tranche, and their cash flows may be quite volatile and unpredictable. These support tranches can be structured in a form of sequential support tranches, accrual support tranche, floater and inverse floater tranche, support tranche, etc. Difference between mortgage-backed securities and fixed coupon bonds. Traditional fixed coupon bonds and mortgage bonds can be differentiated on the basis of several characteristics in the following manner. Let's see a table. In the first column, characteristics are given, in the second column fixed coupon bonds, and the third column mortgage bonds. First, coupon payments. Periodic, normal, semi-annual or quarterly in the fixed coupon bonds, and in mortgage bonds it's monthly. Next point is principal payments. At maturity and amortized, each monthly cash flow payment includes interest as well as principal components. Third, coupon amount. Fixed each time. Next, varies each time based upon types of tranche and cash flow received on pool of mortgages. Periodic payment. Contains interest only and contains interest as well as principal components. Tenure. Fixed maturity. Average maturity life. Bond maturity is an estimate depending upon estimate of maturity of pool of mortgages and cash flow received. Statistics. In India, securitization is governed by Securitization and Reconstruction of Financial Assets and Enforcement of Securities Interest Act 2002. The Act aims to simplify the process of recovery of bad loans from willful defaulters. The Act provides the first legal framework that recognizes securitization, asset recovery and reconstruction. Securitization market is regulated by RBI, and the guidelines issued by RBI provide a strong regulatory and institutional framework for the orderly development of the securitization market in the long run. In India, securitization deals are largely dominated by asset-backed securitization deals, and residential mortgage-based securitization deals constitutes very small proportion of securitization market in India. In India, the loans which are majorly bundles for securitization are commercial vehicle loans issued by NBFCs, which falls under ABS category. Individual commercial vehicle loans are normally bundled by NBFCs for securitization purpose. After the commercial vehicle loans, the next dominant category is microfinance loans under ABS categories. In these securities, the major investors are banks because the debt securities issued against the pool of microfinance loans also qualify for priority sector leading for banks. As per RBI guidelines, banks have to lend minimum 40% loan portfolio to meet the priority sector lending norms, while priority sector include the agriculture loans and loans dispersed to small scale enterprise. If a bank is not able to lend 40% of loan portfolio to priority sector, then in order to fulfill the criteria, they can invest in the securitized debt issued against the pool of loans by microfinance institutions, which are qualified as priority sector lending investments as per RBI guideline. Recently, RBI has widened the scope of priority sector lending, and in addition to agriculture and small enterprise lending, the loan to medium enterprise, social infrastructure and renewable energy are also classified as priority sector lending as per revised norms of April 2015. Now, banks will be able to fulfill the PSL requirement on their own and need not to invest in securitized debt securities issued by microfinance institutions. Thus, revised PSL guidelines may have an adverse impact on microfinance securitized debt subscription by banks. As per data realized by ICRA Brickworks, the pace of loan securitization slowed sharply in 2014-15, with transaction volume of rupees 21,000 crores against rupees 29,000 crores in 2013-14, as shown in the figure. The share of asset-backed securities, including microfinance receivables, had an 85% share in value. One of the cause of this decline is a revised guideline by RBI in which they have raised the minimum holding period of loans and retention ratio. This led to reduction of assets eligible for securitization. The data also shows that share of commercial vehicle loans has reduced over 3 years from 72% to 56% of the total. In contrast, the share of microfinance receivables had risen steadily from 12% to 26% in 2015. Summary: securitization is a process of creating securities by pulling together various cash flow producing financial assets. These securities are then sold to investors. Any asset may be securitized as long as it is cash flow producing. The term asset-backed securities and mortgage-backed securities are reflective of the underlying assets in the security. Securitization provides funding and liquidity for a wide range of consumer and business credit needs. These include securitization of residential and commercial mortgages, automobile loans, student loans, credit card financing, equipment loans and leases, business trade receivables, and the issuance of asset-backed commercial paper, among others. Securitization transaction can take a variety of forms, but most shares several common characteristics. Securitizations typically rely on cash flows generated by one or more underlying financial assets, such as mortgage loans, which serve as the principal source of payment to investors, rather than on the general credit claims paying ability of an operating entity. Securitization allows the entity that originates or holds it to fund those assets efficiently. Since cash flows generated by the securitized assets can be structured or trenched in a way that can achieve targeted credit, maturity, or other characteristics desired by investors. Asset securitization began when the first mortgage pass-through securities was issued in 1970 with a guarantee by the Government National Mortgage Association. The most basic mortgage securities known as pass-through or participation certificates represent a direct ownership interest in a pool of mortgage loan. Shortly after this issuance, both the Federal Home Loan Mortgage Corporation and Federal National Mortgage Association began issuing mortgage securities. Mortgage pass-through securities may be pooled again to create collateral for a more complex type of mortgage security known as collateralized mortgage obligations. CMOs may also be referred to as a real estate mortgage investment conduit. CMOs and REMICs, terms which are often used interchangeably, are multi-class securities which allow cash flows to be directed so that different classes of securities with different maturities and coupon can be created. They may be collateralized by raw mortgage loans as well as already securitized pools of loans.